Well, stocks closing fractionally lower on Thursday as investors remain reluctant to make some big bets in a thinly traded session, of course, ahead of the long holiday weekend and before the start of the year. I want to bring in Jeff Taylor, the co-founder and managing director of Digital Risk. So, Jeff, are we going to come roaring back right when 2017 begins?
Well, obviously, it's been quite the run post the election. As I look into the housing market going to 2017, it's going to be, I think, three big buckets that I'm looking at. One, with the rise in interest rates. Obviously, you're going to see a much smaller market because a lot of the refinancing in the housing market will not be there as much. I think a second thing you take a look at is, as Trump talks about the deregulation that he's really focused on, I think that's going to levy a lot of pressures off the banks. So I think you'll see them getting more aggressive in the housing market as some of that regulation gets in more tune with what it probably was meant to be. And the third was kind of a game changer announced earlier this October, where you had Fannie Mae that rolled out its day one certainty, which really gives more certainty around income, asset, and employment. And that's going to be big for people looking to gain the housing market to make loans as they look to make sure there'll be more certainty around that. And Freddie Mac also announced they'll be doing the same thing, rolling out similar programs later on in early 2017.
Okay, so what are your bets then? You're saying buy banks, buy housing?
Yeah, so I'm long on the financial institutions. I think with the low interest rates, they've been repressed here for obviously a couple of years. So I'm really long financial institutions. I would like Lowe's, Home Depot. I think that this is going to be the year of the home builder, because with refinancing going, I think you're going to see people really, there's still a tight inventory in housing. So I think you're going to see homes really start to be getting built again. And I'm really focusing more on that multi-generational house, whereas housing prices are still a little high. You're seeing this be coming up of literally families getting together to buy houses versus like a millennials going out and buying it on their own.
Okay, but Jeff, I want to bring up a chart here, though, that looks at some of those housing stocks that you like. I know you mentioned Home Depot and Lowe's and Lennar and some other home builders. This chart here essentially shows that they all have pretty much underperformed the S&P index, which is the yellow line on the screen there. All of those stocks, or most of those major stocks, have underperformed. So why would they outperform in 2017?
So that's a great point, right? So again, if you go back to the crisis, sort of the supply chain was really broken over the last 5-6 years as far as really the growth to be able to build new houses. What I really think that what they've done now in the housing is they've really now found good areas, they've bought the land, they're really starting out to build the houses, and I think you're going to start to see a lot of that critical mass really get up there in 2017 and 2018. And eventually, these millennials who have been out of the housing market, they got to come back in. It's still at all-time historical lows, the first-time home buyer. So I'm really betting those are going to be with the catalysts, which are going to make a nice return in the housing sector.
Jeff, what about affordability, though? Because, we have seen mortgage rates have been continuing to rise since December. Let's throw up the chart and let our viewers see, too. And that increase really currently is kind of really in line with around 2/3 of the wake of the taper trend and the rise in mortgage rates that we do see, given the rise that we see in the 10-year as well. We're sitting at just below 2.5 for the 10-year right now. Is there more room for these yields to rise? And at what point does this really start to hurt the mortgage lenders?
Well, I mean, take a look at it, though. We're still talking about like 4% interest rates. I mean, they've risen a lot since the election, but that's still historically low interest rates. So I think what you're going to see is people on the especially on the purchase market, not the refinance market. So mortgage lenders will be hurt because the refinance market pretty much won't exist in 12 months with interest rates getting into the 5s. But I think from a purchase market perspective, I think they're going to actually do very well, because as banks are going to want to lend as interest rates go up. And the affordability factor, yes, you're not going to be able to get maybe as much home as you would 6 months ago, but there's always that balance between what somebody's willing to sell an asset for and willing to buy it for, and that's where it's just going to have to be a meet in the middle.
Jeff, we're going to leave it there. Appreciate your time. Jeff Taylor, co-founder and managing director of Digital Risk.